Sorry for the delay, everyone. We're just going to wait for our fellow panelists. But actually, whilst we're waiting, can you put your hand up if you have tried raising money in the last 12 months? Okay, and keep your hand up if the struggle has been real. So what we hope to get from today is, I guess, insight, an understanding of what VCs are thinking. If you're trying to raise money, come and hustle these guys afterwards as well, and make sure that you remember their names so they can help you on your fundraising journey. I think we're pretty much ready to get going. So thank you very much, everybody. Hope you had a great break. This session is the new venture capital landscape. And as we just saw, it's very real at the moment as well. So I hope you find this session really helpful. We are blessed with an embarrassment of amazing VCs and investors here. It's exciting. It's an exciting period. It's a tricky period at the moment. But today we're going to delve into the conversation regarding the slowdown, really, in the investment space and the repercussions of this. There's definitely been huge shifts in the investment landscape between 2022 and 2023. We've witnessed market trends, including reduced valuations. There's been a heightened focus on profitability and capital efficiency, and there's also been increased cost reduction initiatives. Word on the street is also that some startups have really struggled with follow-on rounds, leaving them in a really tricky predicament. My company, Wimbart, we are a PR agency, and we've noticed this firsthand as well. Last year, we announced almost $1 billion worth of fundraising for our clients. That was almost a fifth of all fundraising on the continent. That has not happened so far this year. It's been a much, much slower year, and I think a lot of other service providers will have seen the repercussions too. So there's definitely been a market slowdown, fewer fundraise announcements, and interestingly, from a service provider perspective, from a PR perspective, we've seen a lot of companies actually positioning themselves for the long term. So yes, there's fewer fundraise announcements, but people are really thinking long term, and they're looking to ride out the storm, but with one eye on their competitors as well. It's pretty tough out there. So some of these areas that I'd like us to discuss today. We're going to be looking at investor sentiments. Investors looking more towards caution rather than optimism. Are we still grappling with the market correction that hit the continent in the latter half of 2022? Are deals becoming more or less competitive? And also, despite the gloomy macroeconomic conditions, do investors still believe in Africa's massive possibilities? So we have an amazing array of VC and DFI experts on the panel today, many of whom Wimbart's been lucky to work with in the past as well. So I'm hoping for a very energized and fruitful conversation. I'm going to ask all the panelists to introduce themselves, no more than 30 seconds, please. And then we'll dive into questions, and then we'll do Q&A towards the end. So please start having think about some of the questions you might want to ask now. Selma.
Yeah, thanks, Jessica. Great to be here. So we are Firstcircle Capital. We are an early-stage fintech-focused fund. We like to enter at pre-seed and seed rounds. We're specialized in fintech, and we're really hands-on helping early-stage fund companies scale and raise follow-on capital. So we see a lot. Yeah, we see their struggle this year raising. We see why some succeed and what are the different strategies that they deploy. Majority of our portfolio is in Egypt, Nigeria, Kenya, and South Africa, but we have a special allocation for Francophone Africa.
Thank you very much.
Hi, everybody. My name is John Lazar. I'm co-founder at Enza Capital. Many of you in the room will know my wonderful co-founder, Mike Mompi, based in Nairobi. So we're a multi-stage fund. We have just come through a fundraising process where we're just finishing the close on a second fund, so we now have close to $60 million under management. And we also have a sidecar vehicle, a growth vehicle, which allows us to invest additional $10 to $20 million per deal. It's very much focused on the key hubs across Africa. We now have 30 portfolio companies, 45 investments, and investments across all of Southern Africa, East Africa, West Africa, also in Francophone West Africa, and our first investments in Egypt. And it's a pleasure to be here.
Thank you, John.
Yes. Thank you, Jessica, for moderating, and thanks to Andrew and Lauren for organizing and bringing us together, like every time. So I'm Babacar Seck. I'm the Senior Investment Officer for Venture Capital and Private Equity at Proparco. So I'll try to explain what Proparco is in one sentence. If you know IFC, we're the French IFC. So we do everything that they do, but we're French. And we started investing in African startups 5 years ago, in 2018. And since then, we have deployed around 150 million euros. We've backed 30 companies through venture debt and venture capital, and we've backed 15 funds. And we're not downsizing, we're growing our program. So the plan is to continue deploying at least as much as we have already deployed in the next 3 to 4 years. Thanks.
Merci. Eloho?
Hi, my name is Eloho Omame. I'm a partner at TLcom Capital. We've been investing in Africa now for about 8 years. We have fully invested a first fund. We're close to closing a second fund. So across both funds, about $225 million of capital under management. We've invested in Nigeria, Kenya, Egypt, and South Africa. We focus on seed and Series A stage transactions, and we invest minimums of about 500K. Very excited to be here, and I look forward to the conversation.
Thank you very much, everyone, for your introductions. Okay, so this question is broadly to everyone, but Eloho, let's start with you, please. In 2 words or phrases, how would you describe the current funding landscape for the last year?
2 words.
Or phrases.
Different and spicy.
Babacar?
So it's 3 words.
Okay.
Back to reality.
Okay. John?
3 words with a comma. Tough, comma, but exciting.
Okay. Selma, beat those.
The year of the bridge, safe.
Okay, and so interestingly, I was speaking to a VC the other day, and they actually said that this year is about a necessary course correction phase. Do you agree? And is 2023 going to be the golden vintage? Selma?
Yeah, definitely agree that this is a very healthy correction we're going through, especially looking back at some of the deals. 21 was the big hype. Is this going to be a golden vintage? Well, we definitely are really lucky to have the capital to be investing this year. Whether this is going to be golden vintage, well, I guess it depends on 3 things. If we have the 3 ingredients, it will. We're quite upbeat on this front. First, valuations. So we saw a major correction. We like to enter at pre-seed and seed rounds. So typically at pre-seed, we like to enter at 3 million or below. It used to be 5 or 8 or 10 or 20. Definitely 3 is much healthier. At seed stage, we are still seeing some hyped rounds. There are some markets like, I believe in Egypt, we see people, there is a bit of a lag, and we see people raising seed rounds at 10 million. We think more appropriate when you have 50K MRR is to raise, at lower levels than that. Interesting thing is that we also, since we warehoused the portfolio before we had our first close last year, we also had an opportunity to top up at some pre-A, bridge to A rounds. And we see there is really the golden opportunity now to pick the best performers. We have some companies that are, tracking between 3 to 5 million ARR, and we've been able to top up and increase our ownership in those because fellow investors are kind of sitting it out. And having that negotiation power and entering that lower valuation is definitely part of the story, how we're going to make it a golden vintage for us. I think another very important ingredient that should not be underestimated is the typology of founders. We think that this generation of founders will be the more resilient, more financially savvy. It's about getting the capital in and then spending it very wisely and getting a huge return on investment. Versus growth at any cost and throwing money out a window on expensive marketing and inflating your CAC. This is a much healthier behavior. And then the final ingredients, really is availability of follow-on capital. Today, this year, we start seeing investors coming back, and what we really need is continued a flow of capital at Series A and B. When it comes to international investors, we've seen some of the tourism capital leave, which is healthy. However, we see many savvy international investors who set up a dedicated team and a bucket for Africa, and that's a much healthier approach, and we like to work with them. So if we have the three ingredients, which we're working hard on, we're hoping it's going to be a golden vintage.
And then, so this current landscape, how much is it being impacted by sort of the global macroeconomic conditions? And I guess to you, John, what are some of the factors that are shaping sort of VC at the moment?
Yeah, look, I think globally factors have impacted. The fact that capital is just cheap capital is just disappearing. We had another interest rate rise here yesterday, another 1%. That's what 10 or 12 interest rate rises in a very, very short space of time. So it's a complete reset. And I think that for VCs generally, and I think this is true just as much for VCs in Silicon Valley or in London, a huge amount of pressure. Remember, they've all been fundraising too, really, really struggling. They're under enormous pressure from LPs to go slow or sit on their hands, some of them. There's also a question around valuations. So lots of VCs are having to finally bite the bullet of downsizing investments to reflect the changing situation, which puts them under more pressure. Some GPs have to co-invest. They're struggling to raise the money to do that, so that's created more pressure as well. So I think it's been a very, very tough environment generally, and I think then we've layered on top of that in Africa very specific, continent-wide issues, definitely issues around exchange rates. We've seen that specifically in some countries. Real issues around inflation, and in Africa being hit super hard by food prices, not least because of the war in Ukraine, and then very specific things in individual countries. So I'm from South Africa originally. Any of you have been there recently know that the infrastructural issues around load shedding are catastrophic, in one word. And we've seen similar things in some other places. So difficult space. But I also think it's beginning to just bounce back a little globally. So we've seen, first IPO coming back to NASDAQ. That's starting to happen again. We obviously have probably a bubble now on generative AI. So VC money is starting to flow again. And so, I would say green shoots. I think the thing for me about Africa is we all just need to stay steady and remember and refresh why we believe in the continent long term. And it's the young continent. The demographics are in our favor. Strongly believe in the opportunity long term. Yes, we have to be patient. Yes, there are risks, but I think the core reason why we're all investing still holds, and not least because we have phenomenally resilient and innovative African founders.
Okay, and you mentioned there, thanks for that, John. You mentioned there as well about high food prices. So I guess in the current funding climate where we've seen valuations drop by up to 50%, what defines success? And this question is to Eloho, but what defines success for startups in a high inflation and high interest rate environment?
So all of those things are true. It's also true, I think, some of the elements that John's pointed out, which is that we are investing in a continent that has some pretty exciting fundamentals ahead of it. And I think the view that we take on the interest rate environment, etc., is that thankfully we are venture capital investors, and thankfully we get to invest for the long term. And so from a founder perspective, I think the appropriate answer to this question, therefore, is if you're building if you have venture capital and you're building a high growth company, then the challenge becomes to deliver growth, but to deliver it in a sensible and profitable way that allows you to be, I think, a venture capital proposition that is attractive to potential VCs without doing some of the things that Selma spoke about. It's a very difficult thing. It sounds easy in theory, but it's actually a pretty difficult thing. So it means that the company has to have some pretty unique fundamentals around it, or at least some pretty good fundamentals, shall I say. It has to have economics that work, or at least economics that work, number one. We've used the word profitability today. I'm always a bit cautious with that word because we're early stage investors, and very often for the companies that we're talking about, profitability is not really something that we think necessarily needs to happen at this stage. But we like to see a path to profitability. We've talked about sensible founders, resilient founders. We like to see discipline around capital efficiency and discipline around how founders think about their rounds, etc. And to the point around resilience, I think those are the founders that ultimately will come through this phase with the stronger businesses, having raised capital, having done it in sensible ways, etc. And I think if that is the kind of business that you're building, you'll find a lot of support from the Africa venture capital ecosystem.
Okay, and then so staying on then the subject of founders, a lot of founders, they found it quite hard to raise follow-on capital in the last year as well. What are the key causes of this, and is it about sort of shifting priorities and strategies on the part of investors? So I guess, and also what are the hard questions investors are asking their founders when you're having those, finance discussions? Eloho and then also Babacar, it'd be great to hear from you.
Sure. I think for us, certainly, we have always been pretty disciplined about how we think about follow-ons. And so there's two ways to approach the answer to this question. If you think about the work that we are trying to do as venture capital investors, there's also the question of thinking about you have a portfolio of opportunities in front of you. You're thinking about things like opportunity costs of the capital, and you're thinking, here is a proposition that is a follow-on potentially, but also I'm probably looking at something else that's potentially a new investment. And what I need to decide at each point is whether or not my LP capital is better invested in this company that I may already be, invested in, and another company outside. Of course, there are other considerations. So for us, we're generally pretty disciplined about follow-ons, and we like to think about follow-ons as an opportunity that we preserve, maintain for the best performing companies in the portfolio. In general, though, some of the reasons why we have seen an environment where follow-ons are generally harder is some of the things that, again, we've already referenced. So it's the fact that there are less investors. There's some of that tourism capital has gone out, for example. So there are fewer. The number of investors who are deploying in Africa, institutional anyway, are fewer. It's the fact that, within the funds themselves, sometimes you have some funds who are in market trying to raise for slightly longer than they had anticipated. And it's the fact that even within the portfolios, you find, understandably, I guess, greater discipline around how we think about follow-ons in general. So it is a harder environment. I think to suggest that it wasn't would be facetious. But in general, again, if we go back to the point around the fundamentals and the businesses that we're building and the propositions that are before us, I still think in Africa, good companies, good founders will find follow-on capital, and then they continue to do so.
Okay. Same question to you, Babacar, please.
She said everything. No, I'll just add one or 2 points. I fully agree with what Eloho said. There's less capital. So, if you try to think about it from the perspective of the investors, the American investors whose core strategy is not Africa, they refocus on their most important companies in the portfolio, and they back them to take them where they want to take them. The African investors who are dedicated to the continent, they're more focused on the portfolio companies in the fund that are most likely to succeed versus those that maybe they invested in on the, maybe let's say in a more speculative way, thinking that they would have a revenue multiple based exit when exit is more likely to be based on more rational metrics. And then also, I think on that point I just made, we were in a world where you could invest in a company that was making revenue, making huge losses, and exit that within 3, 4, 5 years with a very good return, even if you didn't build a good business. So a lot of companies were built with the wrong KPIs driving their strategy. And so those companies, in a world now where, I think we heard profitability at least 10 times since the beginning of this discussion, where profitability, unit economics, strong fundamentals, etc., become more important, and there's less money, then those companies don't fit anymore the framework that the investors are taking. So it's harder to raise.
So my next question is a two-part question. Is there a particular recent investment that you've made that you're excited about? And are there any kind of nuances about that investment that you could share, in terms, or any challenges, or in terms of getting the deal over the line that you might want to share with some of the founders as well, so they can learn from the expertise? Open question.
I'm happy to go first. This is actually a slightly older deal. It's not immediately recent, but one of the first investments out of our second fund was into a fantastic fintech in Francophone West Africa called Jamo, which we co-led with Partech. I'm super excited about this because I think Francophone West Africa is very, very interesting. I think it's underserved. I think it has the advantage that there is an economic union and a single currency across multiple countries, which allows you to scale in a different way. I think, and in this deal is led by a truly exceptional founder who's a repeat founder who has done it before and very, very strong. So I think that's one which we have very, very high hopes for, very strongly growing. And in terms of getting the deal over the line, I think the thing for us that was most interesting was co-leading with a really big firm like Partech, where we were given responsibility for doing a lot of the due diligence, but in particular the technology due diligence. So that was an interesting dance. My background is very much as a software engineer. I led a company called Metaswitch for many years, core communication software. So I'm much more of a technologist and an operator. And very, very interesting being involved in the detailed technical DD along with support, which we then worked with the Partech team on. Very excited about that opportunity and great company.
Great. Anyone else?
Yeah, happy to go second. So we invested, it's a bit an older deal, but I really like to talk about this company. So it's a company called Go My Code. So this is a Tunisian education technology company providing professional education in the area of digital skills. So they have a network of schools across the continent. And how they operate is a very innovative model, which is a hybrid model. So you have 60% actually of the training that happens at home on your laptop and 30 to 40% that happens in class, which creates a lot of efficiency, of course, from a fixed cost perspective, and it's extremely scalable. And the reason why we like this company is not only the hybrid model, but also the fact that the people who go through their training, 70% get a job in the next 6 months. And this is a huge impact when you know that youth unemployment is a major issue on the continent and has caused even revolutions in certain countries like Tunisia. And so this company is training thousands of students now. And I guess what was really important for us to get the deal over the line was, this is a company founded by two brothers. And the CEO is actually quite young. So, when we first saw, the information about the company, we're like, this is very interesting, but we need to get comfort around the leadership team. And we got more than comfort, because despite the fact that this founder is 25 years old, he has the maturity of someone who has worked, for the past 15, 20 years in the sector. And it's someone that you can really work with. It's always ups and downs when you do an investment. And so for us, one thing that's really important is to have someone that, is going to be open, transparent, and is always going to be in a mindset to improve himself and the business. And I think we've been more than satisfied by how things have been going since then.
Selma, anything?
Maybe I'd like to add to one point, maybe not to do another deal dissection. I really love what you said about the founder. So I think it's really linked to the topic now. We have the investment landscape changing a lot, and we have the founders who need to be able to adapt to it. Now, it really links to certain characteristics that we like to, because we enter very early, we like to look at the personal characteristics of the founders. And if we find certain ingredients like ability to accept feedback, which you use the word maturity, but I mean, it's a very important thing, ability to self-reflect, ability to hear the market quickly, process information, pivot, adapt. We've seen, I believe that the generation of founders who have these kind of characteristics will harbor this change and crisis in funding, shrinkage in funding much better.
Can I just add something to that point, actually? I think, especially in the very, very early stages, all of those criteria, 100%, I think there's sort of apart from the business side of it, there's also a sort of, and so what, if you see what I mean. And some of that, I think, which I'm finding that founders are starting to understand a little bit better, some of it also then dovetails into a feature that I could sort of describe as not a word, as fundraisability. And it's really ultimately your ability to raise capital. So the game that you're in is, I'm going to raise a bit of capital, I'm going to grow a company, grow a good company and grow it well. But in order to do that, you need capital. And that also means you need to be able to attract capital. And good investors are looking at the characteristics of the founder. They're also looking at things like how you structure a fundraise and how you think about your fundraise, how you think about your networks, how you build them, etc. And it's a really important feature. I always say fundraising is a skill if you're going to lead a venture-backed company. And it is a skill. It can be learned. You can build tools and assets that allow you to be more or less successful. And that's one thing I think, particularly in this environment, I always like to sort of underline with early stage founders, that it is important to think of fundraising as a skill. And it's a skill that good founders should have.
Well, just one a quick word to add, because I so agree with what you've both said. And I think the best founders combine like incredibly massive ambition with the ability to process feedback. That's really, really important. But the fundraise ability run is, in a way, a subset of like an absolutely crucial determinant of a good founder, which is how do you build a really, really strong network and maintain it? And that network is about fundraising being one piece. It's also about having the right mentors and support. It's people who will challenge you in an honest way and support you. And that is just such a common thread around the best founders. Because it's a lonely job. And having the right support network around you is just absolutely critical. And then fundraising follows from that.
So then at what stage do VCs go beyond looking at the founder and more the sort of broader team? So a larger team is really important. Because you mentioned, John, about having the right people around you as well. And a part of that, I guess, is a growing C-suite team and the operators around the founder too.
So as we enter very early, so, the first assessment is a lot about the founder. It's a lot about the model. How big is the market? Is this a hot M&A space? Like a lot of things, right? But founder is really, I would say, the team, the founder, the characteristics. It's eventually probably 50% of the decision, because everything else will probably change in the next 12 months, may change completely or partially, right? But then at the seed stage already, after working with this team, we understand also their gaps. We see the way they're making decisions, we see the way they're executing, and we're understanding where are the gaps in knowledge, where are the bottlenecks. And already there, if we decide to follow on, and we often, we like to follow on at seed, this part of our strategy, in the best ones, if we decide that, what we do is we like to set up an advisory board already, because we don't have the funding to really hire C-suite at seed. Let's face it, the round size doesn't allow for it. So we like to match our companies with people who build similar business abroad, ideally in another emerging market, or investors who did, like in India, in Central Asia, in LATAM. And we recently topped up one of our credit-led neobank investment in Nigeria, and we brought people who built similar credit-led neobanks in Uzbekistan and in Kazakhstan, and we put them as part of the advisory board, so to compensate for the lack of the C-level team. And then, of course, once we reach pre-AA stage, what we absolutely insist on is a CFO or a senior finance resource, and setting up compliance function, in-house or out-house, but these are we want the senior level knowledge to be present in the team, because we're focused on fintech.
That's interesting. So then you're talking then really, I guess, about discipline, sort of financial discipline. Eloho mentioned it already as well, and governance as well. Yeah. I guess especially fintech. We haven't really discussed fintech much yet. I'm sure we will. But what should good governance look like at startup stage? I guess from startup to sort of scale up, and I guess the reporting as well. Selma, and then maybe John.
I can say just a few words. Like in the beginning, we often have to help pre-seed founders with improving their reporting. Yeah. So of course we're going to be looking at the usual KPIs, but then we like to make the definitions clear. Sometimes there is in up and coming market a discussion around what's a GMV, what's a revenue. Well, we like to take a conservative view on that. Like revenue is really what stays with you. It doesn't matter if it passes through your hands, it's not your revenue. And sometimes there is this, we set the basic KPIs that we want them to report on. And then at the next level, at seed stage, we also already want detailed budgeting to be in place. We scrutinize large expenses. We talk about setting up a board. In some cases, there is already a board set up, in others not. And kind of like really, it's a step-by-step process. By pre-A, there must be a board. We also encourage auditing financial statements at that stage. We know it's expensive, but there are ways to find cheaper providers, so we work with companies on that, because the goal for us is that the best performers in our portfolio will raise blue chip Series A lead, and we know these will be the requirements in place.
I mean, I think just to add to that, I agree with all of that. I think the word governance is actually an interesting word, because I do think for a lot of early stage founders, they go, governance, that means somebody's trying to govern me. And I think maybe we need another word. I think the point around, as an investor, the most functional situations you find are when you really have a relationship that's kind of 50-50 in terms of the direction of the flow. So sitting on a board, I perform two functions. One is I am there as an investor, and therefore there is a governance requirement for me to look after my LP's money. But there's another flow, which is I'm there to support and help the founder. And if it's not 50-50 and the flow is 90-10, in other words, it's investors sitting there going, like, you need to report to me, that's just not very helpful at all. So we need to build relationships that are bidirectional. And one of the things that I always say to the founders that I work with, because I'm on 3 or 4 portfolio boards, is if you develop very, very good information flow to your investors or your other board members, then you're just going to get a better result out of them, because they'll be able to support and help you to deploy their networks to come to your aid. 85% of my time, I would say, on those boards is spent supporting the founders on either fundraising or on operational matters. It's not on worrying about whether they're doing the right thing from a governance point of view. And the final point I'd make about it is when you just look at the nuts and bolts of management reporting, so the 3 elements of management reporting for any company are a balance sheet, a P&L, and a cash flow. Many early stage founders look at that and they go, that's some sort of external accounting imposition on me. One of the things that they need to learn and that we work with them on is that if you actually have reporting on those 3 things, those are the tools and the lens that you can apply to really understanding your business in a deep-seated way. And when you develop the discipline to do that, you get better results, particularly in the current environment where we are worrying about unit economics and cash flow.
Okay. And Babacar, so from Proparco's perspective, what do you look for in terms of good governance for founders and startups that you invest in?
So we invest from pre-Series A to Series C, and we don't expect the same from companies at the different stages. I think I would align with what Selma has said for the earlier stage. Before Series A, we don't expect the companies to actually have a proper board. They usually don't have the resources or capacity to really manage it well because there's a certain level of formality. But starting Series A, we do expect a board. We do expect to have a board that is balanced in terms of having investors represented as well as the founders. And I'd say for the later stage, more like Series B, Series C, we always try to push to have external board members, as in non-investors, so independents that bring a specific area of expertise or knowledge to the company.
And then so moving away from the sort of governance side of things and looking at business models as well, some business models we've seen have become casualties of the new venture capital landscape. What do you consider as the winning business model? I guess that's like the $1 million or $1 billion question here as well, of tech and innovation in Africa, and maybe something that's not fintech as well. Selma, I'm going to start with you.
What is a billion? What is a winning business model?
Winning business model of tech and innovation in Africa.
I don't think there's one answer to that, but if I can talk about ingredients that we like to see that make us believe that this is the winning business model. Yeah. So often we only invest in fintech, so all of them will have a fintech component. We think that given that we're dealing with an environment that is, we have relatively lower purchasing power when it comes to consumers and businesses. We have a level of offline that we have to deal with, that we have to digitize. We have inefficient distribution, and so we're dealing with a lot more complexity. We like to see businesses that are typically some kind of marriage of offline and online. What we like to see brick to click. We understand that if we're going to digitize the continent and digitize and formalize the SMEs or businesses or payments, and turn them digital, we need to first go face-to-face offline and then bring that customer or that behavior digital. So this is one of the ingredients we really like to see. Second, very important one, which relates to relatively lower purchasing power and disposable income, and then the limited exit opportunity versus other markets. We are really strict on unit economics and positive unit economics business models.
Okay. Anyone else got any?
I'll just add to that. I very much agree with all of that. I'll just add to that. I think the fintech nomenclature is not always helpful in the African context. I think stepping back, if you actually look at the constituencies, we do, from a pure consumer point of view, we do have a very, very large number of people who are relatively underbanked or unbanked. That's both a challenge and a huge opportunity. And then picking up on Selma's point, tens of millions of small businesses in Africa that generate an enormous amount of wealth. So I am really, really interested in solutions that actually support those constituencies rather than that in the end that comes down to building solutions which don't just move payments around with transaction fees, but actually create very, very sustainable support for those small businesses in terms of access to capital, working capital, better logistics and infrastructure. So it's broader than just fintech, and thinking about it from a constituency point of view, I think is more helpful.
Fintech is not just payments. There's
Right.
no money in payments. Exactly. Just to clarify.
I would beg to disagree, but that's not the topic today.
Feel free to share.
That's fine, it's fine.
I think the layer that I might add from the TLcom perspective on business models, again, I'd agree with Selma that it's very difficult to pick the one winning business model. Otherwise, I'm sure we'd all have closed our shop and gone home by now if we knew what it was. But we're trying and we're investing, and our portfolio companies are all performing. You'll see the winners and you'll see the components of that. I think one dimension that we spend a lot of time on, and this cuts across all businesses and business models for us, is we spend quite a lot of time internally talking about competitive advantages and competitive strategy, even when businesses are relatively early. And I find that the founders that we gravitate towards tend to be the ones who, not necessarily that they always have the business school language, but they can articulate very clearly what the value proposition that they're delivering is, how that value looks or differs. So they say things beyond, we're doing this, and I know everybody else is doing it, but our team's better. They have a very thoughtful perspective on the value that they're creating, how they will capture it, how they will maintain it and sustain it, and of course, the environment responds. But that's something I find that we tend to like, and that tends to reflect itself across business models, frankly, for us at TLcom.
And then, so you mentioned access to capital, which is important as well. And I think it was the Partech report earlier on in the year said that I think it was 1.5 billion there was in venture debt funding last year as well. So a huge increase on the year before. Is that a trend we're going to see more of in terms of debt funding? And what are some of the other sort of involving investment trends that you've noticed as well? Let's start with you, Babacar.
Well, aside from venture debt,
What are the trends?
I think we've discussed most of them, to be honest. I think people refocusing on the portfolio, I don't see any specific new approach in terms of sectors that are emerging that were not being addressed before. Maybe we see people getting interested a bit more into Francophone Africa. So I was very happy to see Enza Capital invest in Côte d'Ivoire. And that is progressing slowly. But I don't think there's like a major change in terms of sectors or geographies on the continent today. Venture debt is definitely something that's appearing, but I think that's mostly driven by the fact that, one, you have fintech startups that have scaled, and so they have demonstrated a certain performance in the lending business that they were doing, which is now sufficient for these debt providers to underwrite. I think also the fact that you have a number of companies that have reached Series B and above in terms of stage makes it easier for these venture debt providers to provide finance. But having spoken to a number of these investors in the past, since the beginning of this year, a number of them also were underwriting the growth in the ecosystem. And so I would expect this figure to decrease significantly in 2023.
You guys.
Yeah, maybe just the trend that we noticed, and actually we're kind of looking at it at more depth now, is really, we see actually a lot of interest for climate tech, but it's a very broad definition. Yeah, but and unfortunately we start to seeing some hype deals there, yeah, which are like, make no sense. So a bit of a negative that's the negative part of it. The positive part of it, we are excited about those and things that can really be then transformational. They always have to fintech components. So we are now really deep diving into agri-fintechs, which will have an impact, a positive impact on use of resources, farming and climate. But are the models that can really transform the agriculture, make it more productive, and enable access to credit for farmers. So that's one thing we noticed.
Yeah, I just add two things very, very quickly. So firstly, on the debt side, I completely agree with Babacar, because I think what we're also seeing is a maturity of some of the fintechs that are becoming proper digital banks. So these are companies in our portfolio like Affinity Bank in Ghana, Dot in Nigeria, Shara Free Bank in Nairobi, where they have transitioned from a payments model to actually building a proper digital bank where they have to build a balance sheet, they're taking deposits, and then lending, and funding that lending through equity capital is just it's like long-term not sustainable because of the cost of capital. So we do need more of that debt financing coming in. It's not necessarily venture debt. It's the kind of debt Babacar was talking about. And I completely agree with your point about climate tech. I think that is, we're looking very, very closely at that as well. I think there's some very, very interesting African opportunities around that, carefully sought out.
Yeah.
And I think one particularly interesting area is that if you look at biodiversity and the recent COP15 in Canada, which talks about 30 by 30, so that's 30% of the world's land dedicated to biodiversity by 2030. A large chunk of that land happens to be in Africa. Yeah. So we're tracking that very closely, invested in a company in Kenya called Earthacre that's looking at bringing together a much more rounded view about how you do credits that incorporates biodiversity. Those kind of trends are interesting. And there's some interesting companies in Africa doing carbon capture and so on. So it's still early days, but that's an area where I think we all need to focus.
Eloho, any kind of insight into where TLcom is looking to invest going forward without giving away state secrets?
Any insight into where we're looking to invest without giving away state secrets? I will say that we've closed, I think, 4 or 5 deals this year. We are close to finalizing our DD on another. We're in active and relatively early business DD on a couple, so we're actively investing. We're sector agnostic. We don't have a sector focus. We tend to look for some of the features that we've talked about already on this panel. We're starting to, historically, we invested in Nigeria, Kenya for the most part. We made our first investments in Egypt and South Africa. Those markets are both interesting. And it's interesting you mentioned, for example, FX earlier. Egypt and Nigeria are 2 examples of markets in Africa that are sort of challenged with FX devaluations, etc. But we're excited about both of those markets for various reasons, and we continue to invest. I agree, on the point around climate. I think there's lots that's really interesting that's happening in the climate space. At the same time, Selma, you made a point I thought was really interesting, which is that sometimes if you look at the portfolios, I'm sure across all of our funds, the kinds of companies that we're investing in and the kinds of problems that they're solving, just by nature of the structure of many African markets, they won't always, have a climate second order effect, but typically you will see something that's quite positive there from an impact standpoint. And so as much as we think the trend is interesting, I think for us we're trying to be quite careful about how we evaluate that and what thesis I suppose we pursue within the climate space, etc. But in general, I think we continue to do much of the same that we have been doing, and we think there's a lot of opportunity still there.
So sticking with TLcom thesis, but more on the gender lens. So I know that TLcom has a female-heavy partner list actually. So 3 senior partners at TLcom who are all women, and you have the Female Founders Conference every year as well. And I know Eloho as well through your work with Firstcircle. Your focus is very much on like writing checks for female founders. Yeah. In this kind of economic downturn, is there going to be a knock-on effect, a negative knock-on effect in terms of diversity when it comes to, I guess, gender?
Okay. We should have started the panel here because then we'd spend the whole time talking about it. But and it was interesting when we were talking about trends. We talked about the very positive trends, and I in my mind I was thinking about exactly this trend, which is a negative offshoot. But I think, there. The end sort of point and the end kind of expectation that I have is, of course, that it will be a very challenging environment, in particular for female founders. Yeah. I don't think that's necessarily because they are female founders, but what typically happens in an environment where capital is more constrained is that the people who are typically plugged into that environment, for example, or historically have accessed some amount of capital, etc., tend to then be the ones who, some subset of that will be the ones who will probably do okay through the environment. And you're starting off with an ecosystem in which less than 1% of the capital historically has gone to all female-led teams. If you look at, I did a bit of work last year, if you look at the stage and sort of the funnel of female-led startups over the last, I think, about 2 years, what you'll see is there's a lot of ideation and company formation and very early sort of pre-seed deals. But you'll see it trickles down very quickly beyond pre-seed and seed into, if you look at the female founder component across the continent. And so what does that mean? It means that in an environment where perhaps pre-seed deals are a little bit harder, in an environment where the bar to sort of raise capital at the next stage a little, in terms of even just simple kind of revenue traction, for example, it means that if you overlay that in terms of the funnel, then you would expect that it gets harder. Female founders are also compounded by a couple of other dynamics, right? Which is that there is sometimes, it's hard enough to raise capital. The sources of capital that are available to you outside of the funds that are committed to supporting you, like TLcom, Firstcircle Africa, etc. Sometimes you find that there is this very easy conflation between I'm a female founder, therefore my company must be an impact-focused company. And that's a very, very difficult bias to overcome if when you start raising your capital, there's a lot of impact funds on your cap table, unfortunately. And so it ends up being a little bit of this catch-22 and vicious circle for women who are leading tech startups. Comes back to the point I was making around fundraising as a skill. I think it's particularly important for a female-led fund. And what that means is being thoughtful about how I want to structure the round, who I want around the table, how I think about signals in my round and on my cap table, how I think about networks and who else is going to participate in the rounds thereafter, the company I'm building, where I'm visible. These things, they seem trivial, but they are super important, in particular for those founders who tend to be underrepresented. In any ecosystem, in ours, it's Black women, but in other ecosystems, it's other kinds of founders. And I think it's something that I just think we should be cautious of here.
I think I agree with everything that was said. Maybe just one thing, going back to your point about fundraisability and networks. Yes, absolutely. Being strategic is the other part, one part, very important part. And for female founders, but then building the networks for female founders, it's something that can get a bit harder in a male-dominated industry. Yeah. So we see, unfortunately, that a little bit of that negative knock-on effect on some of our female founders. We're trying to help them through that. Mm-hmm. I think it's also, I think actually African VC industry is fairly diverse, so that should help. When it comes, it's becoming more diverse. So I'm an optimist, but it's going to be a tough time, definitely.
Okay.
If I can just add something, I think one point you mentioned, which is really important, is the idea of pipeline. Mm-hmm. If you just focus on founders, you forget that these founders are former C-level who are former, junior executives. And one thing that we try to do in the companies that we work with is to encourage them to consider always female candidates for all positions. Because, it's a quite well-known phenomenon in Silicon Valley, the tech bros, where, you have your friends, you ask your friend, do you know someone for my chief marketing officer position? Of course, he knows other guys. maybe knows less ladies or doesn't consider ladies when he's giving you the recommendation, and you end up with an all-male C-level team, which means that, and then, you know, people know these concepts like PayPal Mafia. Yeah, well, these were all the C-level team in PayPal. Now they've founded tens of companies and funds. And so I think it's important to be very conscious of this when advising, when supporting founders, to ensure that we're also building the pipeline of future founders. So that's something we focus on.
Thank you very much. So before we go to questions, do we have time for Q&A? No. Okay. Come and find everyone here on the panel for Q&A afterwards. But I think let's just close out the session with, I guess, to Eloho's theme of skills. So if everyone can just give like 2 skills that you're looking for founders, if they're looking to raise at the moment, some of the skills and some of the things that you're looking for.
I might broaden that a bit to say attributes.
Okay.
So I think it's one sort of attribute we look for a lot is maturity. Mm-hmm. Often you'll see it in our ecosystem sort of described as really, sometimes people sort of, you know, distill that and say things like serial founders or they've done things before. That is always useful. We don't necessarily expect that, you know, you would have built a unicorn every single time. But I think some degree of maturity around how you think about your business, how you think about, back to the point I was making about strategy, et cetera, how you think about what you're trying to build and value over time is something that is a big feature for us. And another sort of skill or feature is, I would say, something around kind of teams and people and building teams strategically is 2 things that tend to spike for me.
Thank you. Babacar?
Yes. So I think the first one for us would be leadership. And that includes, of course, the team and the maturity aspect. And because it's really important to be able to attract people that are as good or better than you as a founder. And so if we find someone that has that ability to build a culture, build an organization, partner with people and interact, that's really important. And the second is execution, because it's great to have ideas, but, you know, execution is key for us. Sometimes we find companies at the pre-seed level and only invest at Series A, and we see, you know, we catch up regularly and we see what they told us, what happened, what they told us, what happened. And when each time you realize that, you know, they're delivering or over-delivering compared to what they told you, it's a very good sign and it's very encouraging.
Okay, thank you very much. I've been told our time is up, so if anyone wants to know what skills John and Selma are looking for, please come and find them after this session. Please give a warm round of applause to the panel.